one of the biggest issues for many people at the moment is when they've got an insolvent company, what are they going to do with it? Are they going to sell it? Are they going to put it into liquidation? Are they going to try to trade out of it? Are they going to take advice from an insolvency practitioner, somebody like myself? What are they going to do? And one of the issues that's arising currently is this whole area of selling an insolvent company. And the problem with it is that a lot of the players associated with that have initially, and some of them have certainly changed their business practices, but there was a time where you would be able to go to websites where the people were offering these services, and they would turn around to you and say, we don't want the assets, all we want to do is for you to sell the shares to us. And very commonly it was understood that effectively the director would keep the assets, and the person who would effectively buy the company, but they would actually be buying the shares, and there would be a charge. So instead of you actually selling the shares in the company, what would actually happen is you would actually, yes, you would sell the shares for £1, but then you would have to incur legal fees to do the share transfer. And very often this would come at the recommendation or the referral of the person buying the shares from you. They refer you to a firm of lawyers or whatever that they had a connection with. Now, this was a mechanism where there would be various different levels of fees charged to procure this transaction. Some of those fees actually could even amount to similar levels of fees to what some insolvency practitioners may charge for putting a company into liquidation. So there would be no necessary financial benefit. But where it became particularly discredited in some instances is because it seemed to be a sort of a plan that was marketed to, and on the websites it would say things like, we are not insolvency practitioners, and all this sort of stuff. Now, it's absolutely fine to an extent if somebody doesn't want to deal with an insolvency practitioner, somebody like myself. There's no, it is possible to avoid that type of situation. But the thing to remember, of course, is that we are regulated. We have trained for quite a number of years to become qualified to do what we do, which one of the key things that we do will be putting companies into liquidation and then winding them up before they're ready to be sent on the dissolution pathway. So this marketing mechanism where people will say, we're not insolvency practitioners, the question really is that a fair and reasonable marketing strategy? Now, obviously, everybody's got to come to their own conclusions about that sort of thing. I mean, a regulated profession versus essentially unregulated activity. Now, that aside, when you're in the business of selling the company, the shares will be transferred to somebody else. You will conceivably then end up with a situation where you can resign as director of the company, and somebody else will step in from whom the shares have been purchased. They will appoint their own director. And then ultimately what happens to the company is outside of your control. You'll have to hand over the books and records to them. Realistically speaking, you should be handing the assets of the company over to them. But what's not actually happening is you're not actually dropping the debts, because remember, the debts are with the company and they're not with you personally. So ultimately, this business of dropping the debt is a complete non-starter, and it just simply doesn't happen. Now, this particular mechanism became somewhat discredited, and the people doing this type of thing had slightly changed the marketing in some instances, where they're not saying, we don't want the assets, and so on. But nevertheless, there are concerns that this is still going on. But there's a wider question, because there were certain companies that were wound up in the public interest that were doing this, offering this particular type of service. What it has effectively done, because it really, and it was deemed by the Insolvency Service to effectively be subverting the insolvency processes and regime in this country, is it really does potentially taint a director who uses this kind of service as opposed to the more standard processes of putting a company into liquidation and having an independent party, such as a licensed insolvency practitioner, effectively wind the company up for you. It's tainted the process to such an extent now that a director who essentially sells their shares of a company that ceased trading just before it would otherwise normally go into liquidation, and it's got no viable future, and there's no intellectual property trademarks. Ultimately, that director is potentially highlighting themselves all the more for investigation, not detracting from it. Ultimately, in every voluntary liquidation, the liquidator will do a report on the directors, all of them for the last 3 years, to the Insolvency Service. And that will be credible because that will be an independent party that embarks upon it. Even if you go down this route of selling the shares or selling the company, as it's sometimes sold as, the company can still go into liquidation. In fact, in many instances, it still will. It just won't be. You won't have control of the company's records. You won't have control of the company's narrative because you won't be first to the table, as it were, when somebody has to go and see a liquidator. So effectively, you lose control of all of that part of the process. So it's something that you want to consider very carefully. Questions, queries, concerns, give us a shout. We know Insolvency inside out.